Good afternoon, everyone. Hope you guys had a great day so far. Hey, John. Hey, Omar. Let's take a look at what's going on. Again, if you're not in my Telegram, that's where I do post a lot of gamma levels that a lot of people find very helpful. I've been getting a lot of emails recently, people trading SPY, SPX using the levels that I shout out and are doing very well with it. So if you want to get in on that, tradingpub.com/Kane. Always remember that there are scammers out there who are using my voice and likeness and videos of me apparently telling them to do not so smart things. Just exercise your discernment. Those are not me. The only place you'll ever hear from me is on this YouTube channel and that official Telegram channel. That is it. So I don't want to belabor that. So we'll go on and move on and take a look at our markets. Hi, Dan. Good to see you. So let's see what happened today. A little tiny bit higher, right? We just keep creeping a little higher. We are kind of chop. I am expecting chop, not, but we do have a bullish bias inside of that chop. So looks like we'll head up first. Maybe we'll challenge the previous all-time highs or the current all-time highs, and then most likely come back down. There's nothing in this market right now that's suggesting to us super bullishness so that we could get above the all-time high. By the time we get there, maybe that picture will change. But for now, there's nothing that says that we should really be bullish inside of this market. In fact, there are a lot of things that are telling us, hey, be cautious. Like, not necessarily that we're going down, but we're probably not going to be screaming higher. Yesterday, I made the comment about how the market is becoming less reactive to tech stocks and SMH, and that there's more breath coming into the market. So we got AMD earnings that were not great. It did get supported by that EMA 20 though, very interestingly. And that big gap down, even though that happened, SMH, it wasn't really that much affected. And then of course the QQQ is actually up. So the market is caring a little less about that right now at the moment. The big news today was Apple announcing or about to announce, supposedly announcing that it is going to be investing $100 billion in manufacturing in the US. That sent the stock upwards, and that brought the Mag 7s up. Oops, Mags. And then that was the most of the bullishness in the market today. So we saw in the QQQ, and we saw it in the SPY. So QQQE, if I look at that, it doesn't look quite the same, does it? And so actually we are up from yesterday, but that it wasn't like a solid green bar like it was on normal QQQ. There's a lot more wicks right here, and it did not close at the highs. If I look at RSP, definitely not a green bar. It did close lower than yesterday. And so that Apple influence was really in the larger cap stocks. If we look at SPY, right, those two pictures are very, very different. So we do need to exercise this caution. We can still look for really strong stocks because now the relative strength will become more apparent. When you've got RSP down like that, you got SPY kind of going sideways, maybe just barely creeping up. The really strong stocks that are just really trending, they become a lot more obvious. So maybe we'll look for some of those today. The VIX volatility regime, it continues to move downwards. So we did really just spike up above 20 that one day and just really come back down. So that was I guess we didn't officially give a trade or examine a specific trade, but if you followed that general advice of a call vertical spread, then this is you're probably doing pretty well with it. Then let's take a look at so volatility regime, yeah, pulled back. We just want very strong relative strength stocks right now. We did look at certain sectors. We did like boats yesterday, and that's still strong on the 1 week and 1 month basis. Today looks like we're a lot more about a breadth of stuff, actually. Retail, cloud computing, discretionary. So those are all very bullish sectors. And then we've got the uranium and the consumer staples. That's kind of a weird mix. So again, choppiness, it looks like more choppiness inside the markets. Let me also look at, is this the right? Yeah, this is the right one. Okay, so the number of stocks above their 50-day moving average, 53.47%, 56.26%. Those are just kind of middle of the road numbers for both the 50-day moving average and 200-day moving average. So it does look a lot like we're going to chop sideways. If we're going to get some directional movement, then we would need it to see both of those trending up first. CPC, not really giving too much right there. Okay, so let's see if we can find some trending stocks here. And then, why don't we check on that gold iron condor? Did anyone actually take that? I forgot to trade it, but we did track it on our sheet over there. So hi Kirk, hi Barry. Let's see, gold. All right, gold chopped sideways. So that would have been perfect for the iron condor. And so if it continues to chop sideways, then this iron condor would be quite good. And let's take a look at option strat, see how it is looking. Okay, up 7.3% versus yesterday. And you can see we're not expecting a huge, so the iron condor makes its money by time decay. So time has to pass. We have to be patient with iron condors. So price movement, actually, the less it moves, the better, because we're basically centered right in the middle of the iron condor right now. So we don't actually want prices to move. That would tip us, the more time passes, the less we care about price movement. But early on, a price move could send us kind of looking like we're negative, but like how insensitive it is, though. It can go all the way up to 314 almost, and it still look like we're still making a baby profit. And then at 314, and it doesn't even look like really bad, right? 20% loss, 30% loss happens at 304 and 318-ish. But that would be, let me see. It's always tricky with the iron condors or the credit type of spreads, because they always do it off of they never do it off of your max loss. They do it off of the credit. In this case, it doesn't matter because the credit and the max loss are very similar. So those numbers are going to be similar. But usually those returns, they give you a very, very bad actual picture of how it's actually performing against your actual investment. So right now, this is not bad though, because our max loss and credit happen to be the same or very close to each other. So 7.3% so far. If this just keeps continuing, then we can hit that. See, that's what I mean. Yeah. Again, only because our net credit and max loss, or max profit and max loss, are almost the exact same number. So this says 100%. But actually your max profit is not quite 100%, right? It's 48 divided by 52. Okay, so the max we can make is 92.3% on our investment. So that 100% just means 100% of the possible maximum profit. So there's a very wide range of that when we get to at expiration. And then you can see it, the further away we get from expiration, there's a more and more narrow range of prices where it could be close to that 100% until, when a day before in the morning, it's not even possible to make that $48 yet. So that's what I mean. The iron condor is dependent on time passing. And so we just have to be patient with those types of trades. That's why I don't like doing iron condors way like several months out or even a month out. I don't like sitting and staring at a position forever. So personally, I don't like to do a lot of those. Okay, but it's doing well so far. If anyone took it, yeah. All right. Hi, Chester. Are spreads better than just a single call or put? That depends on what you're trying to accomplish. So the and I guess what I'm saying is what does better mean? So are you trying to reduce your risk? Are you trying to get the maximum gain possible? Are you trying to find some sort of blend in between? Do you like time to pass? Do you want your return right away, or do you not care? Do you have a certain time frame that you want it to happen in? All of those will affect the way that those perform. Are you expecting more volatility, less volatility? All of those things will determine whether a return on investment is better on one or the other. So if you're just going by return on investment, again, it depends. There's a certain range of prices where the spread will perform better, and a certain range of prices where the individual call or put will do better. So we have to set up our expectations properly and just say, okay, given my set of expectations, which one would give me the best? Again, what am I looking for? Safety, return, or whatever you define that metric as. And then if it goes outside of my expectations by a certain percentage, then that's another consideration. And if it completely blows out of my expectation, it completely does the opposite of what I think it's going to do, then that is another point of evaluation that we have to make. So in all those three scenarios, I want to choose which one is going to be the best performer for me. Again, you get to choose that metric. Is the best performer means I lost the least amount of money when I was wrong, or I made the most amount of money when I was right, or some sort of blend of those things. Got an exit from Walmart for 50% profit. Nice. Walmart really moved today. Walmart was a little crazy. Walmart. Yeah, Walmart really moved. So 1.68 ATR, and it moved $4 on the day. So it moved like 2.25 ATRs in a single day. That is an outsized move. So taking profits is definitely the right move if you're in Walmart today. Yeah. Okay, so let's take a look. Let's see if we can find some opportunities, something that is outperforming the market. Again, we mostly want to lean to the positive side. We want to follow that trend of the market. And the only reason why I would look at a short is if I wanted to balance out. If my portfolio just had too many longs, then I would start looking for a good looking short opportunity as well. So if I am completely in cash, I'm not looking for a short opportunity right now. It just doesn't make sense. That if I go a long and then maybe I go another long and then I want to balance out one of those longs on my net portfolio, then yeah, I would look for a short, but I wouldn't just look for a short right now. Okay, yeah, learning is excellent, and learning when you don't have money to invest is perfect because you're not tempted to do anything with your money, and so until you actually feel confident in what you're learning, so that's a perfect situation. Okay, so let's take a look. I'm going to look for some of those longs. I'm going to do a little bit differently. I'm not going to look at those sectors right now because yesterday when we looked at the sectors, it wasn't ready yet. But we were looking at boat and we say, oh, we really need a pullback before we looked at it. And then URA, we were waiting for a pullback as well. So, or I said, which one was it? Was it URA? I said one of them I would only consider doing the ETF. I'm pretty sure it was URA. URA is looking not bad. Actually, it's looking pretty good. So let's take a look at. So when we did boat, when we were looking at the individual ones in boat, we were looking at Stellantis, I think, and or not Stellantis, Scorpio tankers, and then the bulk carrier group. So this is after earnings. Was that today? Aftermarket, did they report post earnings? Looks like they're pulling back all the way to the EMA 8. So that might be interesting tomorrow. I'm going to watch that very carefully because if it does open near that EMA 8 or even a little below that EMA 8 or even at the EMA 20, if any of these hold, then that could be, and then they bounce off of that level, that could be a really good entry into SBLK. And then STNG, oops, STNG, I guess I could just click right there. No aftermarket data, but if it will probably move in sympathy with SBLK, so it'll probably open lower. So tomorrow may give us a nice entry into STNG. Of course, that would be early entry. That would be anticipating, because you would actually want, even if you're going to anticipate. So what we really want is, if you're swing trading, is the next day we would have a green bar that confirms the bounce off of the EMA 8. But if we're anticipating, even so, we would wait until we see intraday it bounces off of that EMA 8 as well. So that would be early entry, and then maybe you split up your allocation. And so half of it at early entry, half of it at regular entry. I generally don't like putting everything in on early entry, unless you just don't care. You're like, oh, okay, if it doesn't work out, then fine. I'm comfortable losing that money. So let's take a look at an entire realm of stocks and see what might look bullish that is clearly outperforming the markets right now. So let's put in a few criteria here. Let's go, no, I don't need the watch list. Priced above 20, plenty of volume, and then a couple of ATR and ADX metrics. And maybe I'll get rid of ETFs as well. I'm not too interested in ETFs at the moment. Nothing. Oh, that's why. Okay, that is too many, so I'm going to limit it to, let's say, apply to watch lists, my weekly. So anything with weekly options. They tend to be more liquid, and their options tend to be more likely to have a tighter bid-ask spread. PLTR looking great, gap up right there. I think they announced yesterday. Yeah, earnings 2 days ago. So big gap up, continuation move today. So that is definitely moving. Would not want to chase that. Let's take a look. Just anything that's trending really nicely. SMMT, not as nice as I would like, but not too bad. We'll keep that on there just in case I don't find anything better. Dash, from a high level view, looks good, so we'll look at it in more detail. WPM, wheat and precious metals, that's interesting. And we did see metals and mining looking very good as sectors yesterday as well. So WPM. And I think you do more than just gold. Let's just confirm that, because I don't want a pure gold play right now. Why? Because we did an iron condor on gold. We're not expecting it to really move. So WPM. Mostly gold, silver, and palladium. Okay. Long-term agreements for cobalt and precious metals. Yeah, they might be too concentrated on precious metals, so I'm going to skip WPM. Affirm, big surge upwards. Did they announce also? No, they just really got bid up a couple days ago. That's interesting. But two, I can't chase into this though, so I'm not gonna do anything with it. Urban Outfitters looks like it might be okay. GE is a very, very high priced options, has really expensive options, so I'm not going to do that one. Newmont looking great, a little like volatile, but that looks good. But same thing as wheat and precious metals. I'm not inclined to do anything with gold at the moment. AVGO, Broadcom, that's looking pretty good, but I'm pretty sure they have really expensive options as well. Schwab. Okay, so I think financials should be doing pretty well at the moment. Okay, gap down to MA50, that held and it's floating upwards. So this looks actually similar to the price action as SPY, except weaker, right? Because it's sitting here hanging out at its MA50 rather than EMA20. Meta gap up side and then chop sideways. So that was off of earnings. Okay, so what I'd be looking for right here is a break of that upper range or bottom range, or a chop into its EMA8. Eventually this EMA8 will come upwards if this keeps chopping sideways, and then a touch off of that, right, and a breakout. That would be a breakout play. There we go. BK is looking really nice. Pinterest. COHR. GD is looking pretty good. CEG looked pretty good. Right there. Oh, whoop, no. Where'd it go? Right there. It's looking pretty good. Okay, I think I'm going to end the list there because we have enough. And we're getting halfway down the list. And towards the bottom of the list, those would be more bearish looking ones. Like if I go to the very bottom, yeah, you can see they're bearish over here. Okay, so we'll just take a look at those. So let's take a look at SMMT. Not bad wiki, a little too wiki, but if you're okay with, well, we got earnings. Never mind. Dash looks like just reported earnings. Was that this morning? This morning. Okay, and it didn't really move that much. Didn't really change the picture. So in this case, I might be okay. Normally, I like to wait a couple days after earnings, but I might be okay with this. This looks just fine. Dash looks pretty good. URBN looks good. Not great timing for entry though. You would wait for a pullback. Same with Dash. Dash was a little, wait for a little baby pullback. And then we had AVGO. AVGO looks great. This morning's open would have been a great entry. So I'm gonna pull out AVGO, SCHW, pins, Pinterest, looking pretty good there as well. But not, I guess actually for this one, EMA 20 is a lot better. See how many times we touch that EMA 20? So I'd wait. So this day, last Friday would have been a great entry. Same with COHR. Last Friday would have been a great entry. Today, it's not bad. If we can get in at near the EMA 8, not bad. But let's see. GE. Same with GE. Touches the 20 quite often. CEG. This is okay, but too wicky. So AVGO was pretty much perfect. So let's just go with that. Okay, so how would I trade this? So now we get to the earlier question of spread or call or put. COHR does look good, but I just not as good as AVGO. COHR did look very good. Yeah, I'd rather get it on the EMA 20, but this is not bad at all. AVGO is expensive. Okay, so there you go. That already could say, okay, well, that might eliminate a normal call simply because of price. I might be outpriced. So especially if I have a small account, I go AVGO, I'm trying to go just say month and a half out. I'm paying $1,500 to get into a position over here. So that is a good point. So we could just look at a spread for that. Let's see what core look like, because then I could do a comparison. If it has decent, it's okay. Not great, but not super expensive. You would still need a somewhat larger account, at least $5,000 account if you wanted to trade this. Not super liquid though. Yeah, it's not quite liquid enough. So that's a little unfortunate. Okay, I can still do a comparison. Even though most people wouldn't be paying $1,500 or so for a, you know what, maybe I'll do something a little bit different. Because yesterday I went through Iron Condor. I think the day before I compared a call and spreads. No, when we did the earnings trade, when we did the TJ Maxx, which yesterday I showed you guys how I'd close it out already because it made money way faster than I anticipated. The TJ Maxx trade, so if you go back when we did the earnings trade on TJ Maxx, I compared a call versus a vertical versus a butterfly. So you may want to review that if you want to get specifically the call versus the spread. So today I'm going to just look for how do I decide on a long call? Okay. Liquidity problem on core. Yeah, that's definitely a problem. Yeah. So just for the sake of example, I'm not really expecting anyone to because these are quite pricey. So we could go in and we could compare and say, hey, how do I go and decide? Just say I could afford all of these. My account can afford all of these. It doesn't matter which one. So I have a very large account. I'm just trying to pick among all these. How do I know actually, or even which expiration I want to trade? So let's start from there. So assume we have our trade idea and assume that we have our timing, that today or tomorrow is the timing. Excuse me. And then now I want to go to execution. So how do I trade my idea? My idea is that bullish continuation of the trend of AVGO. So assuming that I did all my homework, I'm happy with the trade idea, and assuming that I'm satisfied that now is the right time to get in, how do I then go and decide on my execution? And let's just say we did the comparison and I just said, you know what, I want to keep it simple and I just want to buy a call. I'm not going to consider any sort of spread. So then how do I go and I decide which expiration, which strike? Would gamma help choose the option? It could. What it will help me do is help me choose a potential target. It'll definitely help me do that. So right now, the first thing I need to know is how long do I plan on holding this thing? Because that's going to help me choose my expiration. So I have earnings right here on September 4th in the evening. So I'm probably not going to hold through that. Okay, so I've got an upper end for my expiration, but that's several weeks away. That's almost 30 days away, so 4 or 5 weeks away. So is there something that can help me decide that, hey, maybe I want to go shorter or longer? Now, it could just be a preference thing. Hey, I like to do 3-day trades. I like to do 5-day trade, 1-2 week trades. It could just be your investing personality that just says, you know what, I trade this time frame all the time, no matter what. Even if I think that the trade can keep on going up or whatever it is, this is my time frame. That's perfectly fine if you know that about yourself as a trader. But let's just say we're okay with anywhere from a day to 6 weeks. Okay, so we know that we're not going to hold it beyond the 5 weeks that it takes us to get to September 4th. And I want to narrow the field down a little bit more. Do I think that I could potentially maybe only do a 2 or 3 week trade? What's going on over here? So one way that we could start to explore that is, as Dan suggested, it is the gamma. And I'm just going to, for the sake of simplicity, actually, you know what? I'm not going to do that. We've been working on, I told you guys, like some of you have asked me for my spreadsheet and all that, but we've been working on software to bring these levels to you guys in a much more sophisticated way, but obviously it's not even close to being done yet, but I might as well just show you a little bit. Let's see, this was AVGO. Let's see if we got that running yet. There you go. Okay. So it looks like we've got a nice little spike right here at 302.5 in AVGO, a call spike right here. A little bit of puts counterbalancing it, but we can see that this blue line is the net of those two. This is going to be visualized differently. This is just the developer's first stab at it. Eventually, you're going to be able to see a lot of things other than, right? So you guys have seen my Excel sheet before. You've seen my own software before. We're going to be able to visualize that. But I'm also working on something cool where, let me see. Actually, let me just do this. Where we do AVGO, let's just say to September 5th. Okay, because that was the time frame we were looking at. And we see here, actually negative gamma on 290 all the way. Well, then this is not a great example. But that's information, right? So maybe I shouldn't be going all the way out to September. There we go. If I only go out to the end of August, there's plenty of positive gamma at 320, 330. And then if I go out 1 week before that, there's some right there at 305, okay? And then we saw in the other software that we're working on, 302.5, so that could be appropriate. Right here, we're at 300, so 302.5 isn't a huge target. So we probably want to stick with that 829 time frame because that has a lot more exposure to the upside. And so if I want to be conservative, I would go after 320. And if I wanted to be a little bit more aggressive, I could target 330. But what I can do here is the developers are working on what it would become a price graph. Okay, and then we would draw lines over here on points and on interesting levels. So over here, I see that the largest concentration of gamma is up here at 320. And so that we would have a bullishness towards there. We've got a negative gets at 270. We saw 290 earlier. So that's actually a transition point from 290. So what this is telling me is that if AVGO breaks 290, it could easily accelerate very quickly down to 270. So if this thing breaks, the support that it has right here, basically the lows of these bars, this could easily flip. Well, actually, it's a little bit lower than that. But it could easily flip it and go all the way down to 270. So that's good information to have. And I could also watch for AVGO to break. Because right now I could say, okay, well, maybe the last 3 days, it looks like it's chopping sideways. Maybe I don't have such a strong bullish bias. And so if it breaks down, maybe I would target that 270. But while it did break above 300, if it stays up there, if we get a confirmation bar, then I'm going to play this thing to 320. And so we get the price chart and the important gamma levels, and we get to see now we can make a trading plan. Okay, so I know, I have a trade idea that AVGO is going to be heavily followed, and overall I'm very bullish on it, but it could maybe go down before it goes up, and I want to be prepared either way. And so if we break this 290 level, I'm going to play it to the downside to all the way till 270, and if it bounces and recovers, then I'm going to play it back up to 320. See, now I'm starting to develop a long-term plan that covers multiple trades in this case. So these gamma levels can really help us decide on a plan that we might want to execute. So what we've discovered through this process is that we want to target, for now, I'm not expecting this to break down, and we have a nice strong uptrend. So more likely it's going to stay above that 300 and move upwards. That's what I'm defining as the higher probability event, based simply on price action and basically technical price action. And the fact that we are seeing support levels in the gamma as well, and that gamma gives us a nice target, and it gave us, based on the expiration dates that we were looking at, it also gave us a time frame. So we're working on putting all of that into my gamma exposure software, which I will, once it's ready, I'll release it to everyone. Everyone will be, it'll be available for everyone, or access will be available. So over here, I'm gonna draw 320 for now, say that's my target, and I want it out to the 29th to get to that. It could hit that sooner, but I'm gonna give it up to the 29th. Okay, so now that I know I'm going to be out to the 29th is my time frame on AVGO, then I've got to decide. I'm probably going to trade either the 29th expiration or a couple of weeks after that. So 2 to 3 weeks after that. If I choose to do the 29th exactly, then the only things I'm considering are in the money. That automatically chops everything out of the money off the consideration list. If I go all the way out to September, just call it 19th, because we'll get more liquidity there just by going an extra week, then I can start to consider at the money and maybe a little bit out of money, but I never want to go super far out of the money. Right? To make this a little bit simpler, I don't want to compare multiple expirations at this particular moment in time because it'll take me a really long time to show you guys everything. So I will just pick September 19th as my expiration. And that way I can say, okay, I can evaluate, do I want to be in the money, at the money, or out of the money? Now, the most important thing to me personally, Kane, when I look at this is I do not look at deltas. I do not look at deltas. I think that is, I think it's overused. People don't really understand what they're doing when they do that. And the few guys who do understand that, they're using it as a general rule of thumb to just quickly pick an option. And it works okay. It works well for them, but it's not optimized. And I rather have it optimized. It doesn't take me that much more time to evaluate which specific option I want versus just saying like, oh, I'm just going to trade the 70 delta. Okay. Oh, okay. Well, most of the time that works out pretty well. Most of the time it's not going to be the best option, but it'll still perform really well. So if I take a little bit of a time, I can choose maybe a better option to work with. Okay. So one very important consideration that most people don't, I've actually never seen anyone talk about this before, is the amount of extrinsic value I'm paying versus the amount of time I've got left. So basically extrinsic value per day. So I've got 44 days here. And so this works really well across expirations too. Maybe I should have done this. You know what? Let me simplify this a little bit and I'll show you. Let's just say rule of thumb, we always trade at the money. Okay. How do I know if I want the at the money 29? Well, actually, I would never want the at the money 29 because I plan on holding it till there. But let's just do the comparison just so you guys can see it. The 29 versus the 19, or maybe even versus the 12. Okay, so if I do the 29 and I do my extrinsic value right here on the 305, maybe I'll do an Excel sheet so I can keep the values on the screen. Where'd it go? Hopefully you guys are learning a lot. Things that you don't learn. I know like you learn a lot from some other guys too, like Roger is really great at teaching, but hopefully you're learning different things. Like he and I aren't covering the exact same stuff. All right, so and then I need to get you guys back because otherwise I'll just never look at the chat. Okay, so right now this is the 29th of August expiration, 305, and I've got a 10.8 extrinsic value, right? Yeah, 10.8 extrinsic value. I've got 23 days to expiration, and so that is 47 cents per day, okay? Then I go out to September 12th. Okay, and oh, you're welcome, T-Man, 84. If I do 305 over here, then I've got $17.32 of extrinsic value. No, is that right? $17 of extrinsic value. Let me make sure I got that previous one right also. $10.82. $10.82, I'll just keep it at 1080. $17. And okay, well, let's put these on first. $17 worth, and we've got 37 days. And then we've got the 19th of September, 305. This one's going to be 44 days, and extrinsic value, it doesn't have 305. The best we can do is 310, okay? So if I really wanted apples to apples, I'd be doing 310 on these also, but let's just see how this works out. So the extrinsic value here is 1580. And since we're actually at the money, we're actually the first out of the money, you'll notice that the extrinsic value is the exact same as the mid right here. Okay, so basically 100% of the value in your option is extrinsic value. There is zero intrinsic value. Okay, so 1580. Okay, so look at that. So even though this one was $10.80 and this one was $17, when we looked at it on a per day basis, we're paying pretty much the same amount per day in extrinsic value. But take a look at this September 19th. We're going out to 310. So that's a little unfair comparison because that it's going to cause this to be a little bit cheaper. But over here, I am paying about 10 cents less per day for that 310. So let's take a look. Let's do the fair comparison. Let's do 310 on all of them. But what we're saying is I'm paying a lot less extrinsic value per day on the 19th so far. Okay. So let's look at 310 on the 12th. This one was 1467. And then if I look at August 29th, 310. Okay, this is $8.55. Okay, so what we see here is it is expensive on September 12th. There is, for whatever reason, the price is on a per day basis. I'm paying more on September 12th than I am on August 29th or September 19th, and I'm paying the least on September 19th, okay? And my explanation for that is liquidity. Okay, this is the monthly expiration, and so because we have a little bit better liquidity, we're getting a better quotes over here, and it's actually cheaper. So if I was going to decide, hey, am I going to go at the money on August 29th or September 15th, because my plan is to hold no later than August 29th, right? Oh no, it was September 4th. Is that right? No, actually. Well, for whatever reason, we chose October 20th or August 29th. So if that was my choice, then I would just go, you know what, let's just go out here. And on a per day basis of, I'm not paying that much more extrinsic value. And then guess what would happen is at the, let's just say it goes nowhere, like we stay below 310 the whole time, then this one would go to zero. This goes to zero. So I lose my 855. This one goes, how many days to expiration is this? So 29, that's 23 versus 44. So there's still 19 days when the 29th expires. Okay, so this thing is going to be worth 19 times this still. Okay, it's still going to be like 682. So I'm not going to lose 100%. I'm going to go down from 15.8 down to 6.8. Okay, and if I do this minus this, okay, on an absolute basis, I would have lost a tiny bit more than I would have over here, but on a percentage basis, I lose far less. Okay, so this would be for that minus that divided by that. Okay, so I would lost 56% versus 100%. So this is a lot better utilization of my money. It's a lot better reward risk. There's a lot better risk and most likely a much better reward risk because the risk is already significantly different. So the reward would have to be significantly poorer on September 19th versus October 29th to make up for that. And it's probably not going to be that big of a difference. If there is a difference, it could even be better. So the reward risk is significantly better at September 19th. I already know that without even knowing the reward because the risk is already significantly better. So I would choose this September 19th and go with that. And again, this was assuming that we already knew we were going to trade at the money. But because of what we just went through, I saw the 305 and the 310, and I saw that the pricing is better on the 19th. So now I can say, okay, well, I'm definitely going to go with the 19th expiration. Maybe I don't want the at the money. Maybe now I start comparing at some in the money, at the money, and out the money. Okay, so that's all I'm going to have time for today, because if I'm going to go through that, it's probably going to take another half hour to explain everything. But hopefully, did that make sense? Any questions about that? It's a very simple evaluation. It's just extrinsic value divided by the number of days to expiration. I always have to wait for the delay, so. Okay, I'm not seeing any questions, so it seems like that was simple enough and pretty clear. I always love very easy ways to make risk determinations. I think you might have saw that yesterday with the Iron Condor. It's an easy way to determine if your risk is in your favor. And this is an easy way, at least it's a simple calculation and comparison to determine which expiration you want. And then it'll be a similar evaluation, same metric to evaluate amongst the strikes as well. Okay. All right, so we're going to end it here. I hope, again, you guys are learning a lot. If you have any questions, email me, kane@investpub.com. If there's anything that you want me to cover, same thing. You just email me. I'll be more than happy to answer. I'm more than happy to dedicate a session to teaching you guys whatever you guys want to learn. All right. Have a wonderful rest of your night, and I will see you guys later. Bye, guys.